At this hour, this is the show where our reporters at cnbc TV 18 get you a check of all the top stories of the day. I'm Kritika Saxena. You're watching Reporters Diary, starting now. Well, first up, let's get you the action from the last street. Markets ended at a day's high. The Sensex ended the day about 350 points higher and reclaimed 36,000, while the Nifty neared 10,900. The IT and financials were the clear top contributors. The Nifty IT gained about 2% intraday. Surbi Upadhyay is here with the wrap of the day's market action. Surbi, no Monday blues for a change on the Lal Street.
Well, a positive start to the week for sure, especially if you were looking at the large cap screen, because there was plenty of momentum and we ended at the highs of the day. Always a good thing. The only caveat is that after 3 days of outperformance last week, mid-caps chose to take a bit of a backseat today. The mid-cap index was up only 0.3%, whereas the Nifty was rallying a good 85-90 points. Let's look at, of course, the large cap rally first up. It was very broad-based, so that's, of course, positive news. That's thumbs up. If you look at the constituents, lots of tech stocks at the forefront. TCS and Infosys were, really right out there on the front foot. Gains of about 2.5–3% on those stocks. There was Yes Bank that was gaining ground as well. Some cement names like Grasim, Ultratech, they did well. And then there were other stocks as well. It wasn't a very narrow day today. For instance, UPL, fresh 52-week highs for this one. It's been a dream run for UPL since that acquisition. The HDFC Twins were in positive territory. ITC played its part. Even ICICI Bank managed about a 1% up move. Actually, the Bank Nifty did well today as well. Now, what was the problem area? In terms of a single stock, Adani Ports definitely goes down because of this acquisition of a group logistics company that's been done by Adani Ports. The market is raising several questions about the synergies and about the costs, etc. So that stock was down 8–9%. And then if you talk about the downside today, you had Reliance Industries, which was sitting out of the rally, SBI that chose not to participate, and L&T also was fairly subdued. In addition, some profit taking on Bharti Infratel and even on BPCL. On the mid-cap screen, all was not lost because quite a few interesting big mid-caps also managed to find takers today. Motherson, for instance, look at the move on that stock, 11% up today. Kajaria was again about 4% higher. Raymond, DCB Bank, very active stocks in the market. And sugar is a very interesting space as well. There was a major sugar rally playing out, all kinds of reports, whether there'll be more packages coming this industry's way ahead of elections. Anyway, that really helped the sector rally big time today at least. On the mid-cap side of the screen, DLF, Oberoi Realty and Jet Airways were some names to look out for as the rally, particularly in real estate, completely petered off by the end of day. Let's say it's a positive start, but we need more mid-cap participation.
Okay, Survi, thanks for that. And on to stock-specific action. Shares of Adani Enterprises closed over 3% up after the company won 5 airport bids. Now, we understand from sources that Adani Enterprises will be operating airports in Ahmedabad, Jaipur, Lucknow, Mangalore and Thiruvananthapuram. The bids for the Guwahati airport are likely to open tomorrow. And at the back of that, of course, we saw Adani up and about in trade. Staying with the Adani Group, Adani Ports stock nosedived over 8% after the company announced that it has acquired logistics business from Adani Enterprises in a deal worth about 946 crore rupees. Now, the street is concerned about this acquisition because it has been done at a premium valuation and also because of the concerns over intergroup exposures and high pledged shares. Brokerages have given mixed reactions to this very transaction. Citi has downgraded the stock to neutral and raised questions on the company's capital allocation. However, CLSA has maintained a buy call here and said that agri-logistics is a high growth and underpenetrated business. It has warned to keep a lookout for whether the group merges more assets into the company. Earlier today, Anisha Jain caught up with Karan Adani, the CEO of Adani Ports, and began by asking him the rationale behind this very acquisition. Take a look.
Actually, this is a very good acquisition for us from Adani Logistics point of view, because we see a lot of growth potential in the agri sector, especially with government's focus on developing warehousing at agri level. And we are aware that there will be another 6.5 million tons of new tenders which will come out in next 3 to 5 years, and so that's why we see a lot of potential in this business, and it fits in very well in our with our logistics footprint that we want to create in the sector.
Okay, Karan, so that answers the question with respect to the rationale of this deal. But the other concern that the street has is with regards to the 950 crore valuation. Now, a lot of brokerages are saying that this is a bit of expensive transaction. Since this is a group transfer or related party transaction, was there any valuation done in terms of the independent valuation, as well as would it need any more regulatory approvals going forward?
Sure. So, yes, there was an independent valuation done by EY. This was, as you know, it gives a transaction between two listed companies, that is Adani Enterprises and Adani Ports. So there was, all the deals were done, valuation was done on an arm's length basis. In terms of valuation, see, today this company does an EBITDA of 100 crores. And it has take-or-pay contracts, which will take up the EBITDA to almost 170 crores by FY22. And then apart from that, there is a lot of growth potential. So we see at least doubling of this EBITDA in next 3 to 5 years' time.
Okay, so doubling of EBITDA over the next 3 to 4 years. But how are you going to fund this acquisition? It is a 950 crore acquisition that you're supposed to pay in cash. Are you bringing in more debt for this?
No, we will not be bringing in debt. So as we told the market and as we've always been saying, Adani Ports has a free cash flow generation. This year we will have a free cash flow of almost 2,000 crores, 1,750 to 2,000 crores. So we will be using that free cash flow to do the acquisition. We are not going to increase our debt for this acquisition.
Okay, so let me scratch that point more as far as debt is concerned. Now, the last I remember, your overall debt was around 20,000 odd crores. Any word on that? Are you looking to bring it down? Because there is a bit of concern that with this new acquisition, the cash generation might slow down in the coming years.
See, our net debt to EBITDA, if you see, it is at 2.75 times. And as our debt covenant, international bond debt covenant is at 4x. So we are very well within our range and very comfortable in terms of our debt position. Most of our debt borrowing is on a long-term basis, which are anything between 5 to 10 years. So we don't see our debt increasing or debt reducing because of this. And obviously, as the EBITDAs keep increasing, our net debt to EBITDA will keep coming down over the course of year.
All right, so that was an exclusive interview with Karan Adani. Let's get to court action then. The National Company Law Appellate Tribunal has directed financial institutions not to declare any entity of the debt-ridden IL&FS as a non-performing asset. The lenders must approach the Appellate Tribunal before making any such move. A government-appointed board under Uday Kotak is currently overseeing the resolution process at IL&FS. Ashmit Kumar is here with more. Ashmit, some solace clearly for IL&FS. Take us through the NCLAT order and what was the need to restrain lenders?
Well, some more relief, as you correctly pointed out, coming in for lenders. Keep in mind that at the last hearing, the NCLAT had directed that the green companies, the companies that have been flagged as green, will be allowed to make those repayments back to the lenders. That was, of course, at the last hearing. Today, we find that there is no requirement to classify these companies as NPAs. Now, the order essentially is that any financial institution, which is essentially a reference to lenders, will not or cannot move ahead and classify any of these companies as NPAs, even if there is a default. And the only way they can do so is by moving the NCLAT and seeking the prior approval. That's the only way forward. Now, the reason for that essentially is what the lenders are saying on record is that there is a revival plan that is currently in the works. For that revival plan to take effect, it's important that there is no disturbance by way of these classification of the companies as NPAs, and that is one concern that has been appreciated by the NCLAT. And towards that extent, it made the same observation that we do not want to hinder the revitalization, the revival process, and as a part of that, this direction has been issued. But what's interesting, of course, is that this benefits lenders towards the extent that they do not have to reflect the 91,000 crore rupee debt. That's the total debt burden. That does not need to translate into now the accounts and the books of accounts of these lenders. So towards that extent, some relief coming in. And what's also interesting is that this NCLAT order runs contrary to a present RBI norms, which clearly says that unpaid dues beyond 90 days gets classified as NPA. So interesting directions coming in. We'll of course have to see at the next hearing that the course is charted out by the NCLAT, but clearly as of right now, relief coming in for the lenders. Back to you.
Well, let's get you a big global exclusive interview. Warren Buffett is in conversation with CNBC. Let's cut across live to that exclusive interaction.
If you tell me that 3% long bonds will prevail over the next 30 years, stocks are incredibly cheap. Okay. Because even, I mentioned that Kraft Heinz earns $6 billion on $7 billion of tangible assets. Even if you pay $70 billion and you earn $6 billion on it, that's better than having $70 billion out in 3% government. Interest rates govern everything. And if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here, but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, this has not been the history of the United States to have these continued low interest rates. So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire was the least active in the public markets in the quarter when the stocks were the cheapest. You also did fewer buybacks in the fourth quarter when Berkshire was cheaper. Was taking the foot off the gas in the fourth quarter a conscious decision? And based on what you just said, we got all these signs that look like the Fed was not going to be raising rates in the fourth quarter, too. So why wasn't that a buy signal for you?
Well, I thought stocks were a buy in the fourth quarter, just like they did in the third and second and first quarter. But sometimes we have other things in mind, too, that may use a lot of money, and sometimes they work out and sometimes they don't. But
what does that mean? You were holding your cash in case a deal came through?
We had at least one deal possibly that would have been very large. And so I liked stocks in the fourth quarter, but I would like buying a business even better.
Is that deal?
And incidentally, I did say in the annual report that we expect to be net buyers of stocks in this year. We have not been net buyers, I should point out. I mean, the market's gone pretty much straight up. I still think stocks are more attractive, but I have trouble buying it when every day it's up.
The deal that you just mentioned, is that potentially still on the books?
No.
So it's
I don't think it is. No.
Is it a deal here in the United States?
Yeah, is it bigger than yeah?
Is it bigger than a bread box?
I'll give you a hint. It's on this planet.
So you went out of your way in the letter to say that you do think buying businesses outright is more expensive, even though you don't think stocks are too expensive.
No question that, yeah. In stocks now, you have or businesses, I should say, you have a huge buyer, and that's not only, and companies are eager to buy too, but you also have private equity. And I don't know whether private equity, it's flexible because they can call on their partners for more money and all that, but let's just assume that they would have $1 trillion available. Now, they use a lot of leverage. They call themselves private equity, but they're really private debt, to a great extent. But that $1 trillion might buy as much as, say, $3 trillion of assets if it was leveraged with $2 trillion of debt. Well, the total stock market is something like $30 trillion. And if you take the top 5 companies, you knock or 6 companies, you knock $4 trillion off that. So you're down to something where the buying power of private equity, plus just the normal buying power from companies that want to get bigger, it's just a huge amount of competition.
When you start looking around, do you think the private equity companies are overpaying for this, or can they make it work?
They'd rather not. I mean, they obviously want to make the best deals they can, but they are in a game that is so much more competitive than it was for them. If you go back to the 1970s when leveraged buyouts started, which are the same thing they're doing now, but the name kind of lost its appeal there at some point. But the deals you could make then were enormously more attractive than the deals you could make now.
Let me ask you one more question that came in from a viewer. You've kind of answered this, but there may be a little bit more to the answer. This is T84 for the control room. Nick writes in, why didn't a large acquisition happen for Berkshire during the fourth quarter 2008 sell-off? Are you anticipating a much bigger decline in the market? Or was, I guess maybe it was the timing of it. Maybe it was so quick.
Yeah, well, there too, in 2008, for example, we were going to buy Constellation Energy. We ended up buying the stock and making some money on it. But that was part of a deal. When Constellation fell apart, and it was in the fall of 2008, I was watching the tape, Dave Sokol was watching what was going on, and we practically called each other at the same time, and he was on a plane with Greg to Baltimore.
Greg Abel?
Yeah, that day. And we contracted to buy it, so we were ready to buy that, and we tried on other things, but we participated in marketable securities big time at that point too, as you know. We spent, I think we spent $16 billion in 3 weeks, when nobody else was spending anything.
When was that?
Well, between about September 15th and October 7th or 8th. And then we already had another $3 billion committed to Dow, which was not going to get taken down until later on. So we went through our cash pile pretty fast, too fast, actually.
You have a huge cash pile right now, though. What is it, $112 billion?
Yeah, we're.
And that doesn't even count the other $20 billion in cash-like.
No, that does count. I mean, but the 110 or something like
13,
that.
Whatever
That counts 20, and you know, I never get right down to 20 anyway. But we've got a lot of cash, and we'd love to use it. But we're a private equity firm that's going to borrow 6 or 7 times what they call EBITDA, which I don't use as a metric. They're going to pay more than we are. And, you know, as I said, we paid too much for capital. If you pay too much for something, it doesn't accommodate you by earning more money to make you look good. It earns what it earns. And if we'd paid $10 billion less for crap, it would have still earned the same money, you know, basically.
This question that comes in, this is F7 control room. Doug Wofford writes in, Warren, when you come across bad news on a holding, for example, Kraft Heinz, can you share the sequence of criteria you use to determine if the stock is on sale and buy or a bust and to sell? What really concerned you as to what is in back of a dip?
Yeah. The stock market is there not to instruct me; it's there to serve me. So, if there's bad news and the stock goes down, the question is, is the long-term valuation changed? And you know, there was certainly bad news at Geico when we bought it, for example, but there was bad news in American Express when I originally bought it back in the 60s. It was the best investment the partnership ever made. So what you like is bad news about a fundamentally good business. And then you got to make sure that it's still a fundamentally good business. But no, bad news on a good business. We're better off because Apple stock is down significantly from where it was 4 or 5 months ago than if it stayed there. Apple will probably, they may not, but they have said they're going to go down to cash neutral. They could do it either by acquisitions or dividends or repurchases, and my guess is it'll be mostly repurchases. They're about $130 billion away from cash neutral now. If the stock were at 200, it would buy 650 million shares. If it's at 150, you buy close to 900 million shares. We're way better off, if it's at a lower price when they're repurchasing shares. Our partners are selling out to us, and they're selling out cheaper than otherwise. The worst thing that can happen from our standpoint with Apple is it sells at 230 or something like that, because we don't like buying it as well at that sort of price.
We have a lot more to talk about with Apple. There are a lot of questions that came in from shareholders on that, too, or from viewers on that. But we are coming towards the top of the hour and make sure that we make this a good business. Jim, I'm going to send it back to you right now.
Okay, Beck, thanks. We have a lot more, obviously, coming up. Still have 2 more hours of the Oracle, Warren Buffett. We're going to talk a lot more about it.
No, that was, as you can see, the oracle of Omaha, Warren Buffett, talking about stock markets, investments, and how they have made better decisions than private equities in recent times, at least. Let's get back home to an important story that we've been tracking over the last 24 hours. In a bid to boost residential real estate and affordable housing, the GST Council has decided to cut the tax rates for the sector. Under construction properties, which had a tax rate of 12%, will now come under the 5% bracket. For affordable housing, the 8% rate has been done away with, and now they will see a 1% tax. But in both these cases, builders cannot claim input tax credits. Sonal Putra is here to explain how this move could impact this sector. Sonal, take us through the number crunching that you've done so far.
Thanks a lot for that, and as you rightly pointed out, lower GST on both the premium housing and the affordable housing segment. For premium housing, it has been slashed to 5%, and for affordable housing, it has been slashed to 1%. But remember, it is without any input tax credit. The other reforms include that the area cap for affordable housing projects in metro and non-metro has been increased to 60 square meters and 90 square meters respectively. Also, the definition of affordable housing has been changed, and any house which costs below 45 lakhs will be considered as an affordable house. Also, GST is exempted on transfer of development rights, JDA projects, that is joint development agreements, and also on FSI. So these are some positives that are coming in for affordable housing. While we do have a lot of positive and negative impacts of this particular reform that has been taken, Axis Capital says that the positives will outweigh negatives in short term. So the negatives include that there will be a margin pressure of around 3 to 4% as the input costs will have to be passed on. The positives are that there is strong boost that is given to affordable housing, and 85 to 90% of unsold inventory is in this under construction segment. So that will give some boost to demand, and this will overall liquidate this inventory that is there in the system. So overall, while we are saying that there will be some negatives, this is a sentimental positive for the real estate sector. Back to you.
Turn that into, people need to do that. Geico, what the heck is a Geico? It's a government, it would have gone nowhere. But you ramped up all that ad spending, and look at it now. So, you really sort of, they owe you, the whole advertising industry.
Joe, I am so glad that you remember that I was the one that came up with the idea of Geico, the gecko.
That lizard.
People at Geico people at Geico misremember that entirely. They think it was their idea, and I remember the days I sketched that little guy out and said, "Why don't we try the?"
That happens on the show a lot. I know. Neither one of us get credit where we, the people forget what we do.
Yeah, I know that.
All right.
Yeah. Well,
our
day will come.
Hey, Warren, let's talk a little bit about what Joe was just talking about. And Joe, stay there because I know you wanted to ask about BYD. That might play into this. The trade talks with China.
Yeah.
How big of a deal is that? What have you seen on your companies, on your investments?
Well, I see the monthly reports from the companies come through, and a fair number, not in insurance at all, obviously, but a fair number of the tariffs have had some impact. Now we're talking 10% tariffs, and a number of them say if it were 25%. There'd be some big adjustments. Some of it, the suppliers have swallowed over in China, and some we split with them. But it pushes prices up. There's no question about that. But it hasn't had a big effect at 10%. A number of them told me at 25%. The world changes. You either get a lot more money for your product, or you source it differently, or you do something.
So are you relieved to hear of the deadline being extended and being pushed off, that March 2nd it's not all going to go to 25%?
Well, I'm relieved at the idea that there's still some chance that sense will prevail. It is bad for China. It's bad for us if we get into some kind of a trade war. And negotiations are tough in something like this. This is a big deal to both countries, and to some extent you're playing a game of chicken, and because it hurts both countries. And I generally think when two very smart countries have something very important at stake, they'll end up making rational decisions. I've been figuring that way with the Russians ever since the nuclear bomb. That even though you get all kinds of tensions, and people generally figure out what's best for themselves, and the best thing for both China and the United States is to work out something sensible that both sides can live with.
Did you think there was valid reason for amping up these negotiations, for saying, hey, hang on a second, we're not getting a fair shake?
Well, I think we haven't been getting a fair shake to some degree, but I think we can sustain, I mean, to some extent, the United States can do things that no other country can do. So as I think a number of smaller countries, for example, if they want to run trade surpluses with us, I mean, and it strengthens their economy, it doesn't hurt us that much. I mean, I think we've got a role to play in the world that way, but I don't think we can be Uncle Sap either.
Joe, you have some breaking news?
Yeah, out of General Electric, breaking to a lot of us that we realized GE had this much money tied up in biopharma. The company General Electric is selling its biopharma business to Danaher.
Okay, we will keep getting you that interesting interview through the day, but for now, let's get back home. And another important story that we have been tracking, the big development from the e-commerce space. The government, which recently came out with its draft e-commerce policy, has made a strong case for data localization. It has highlighted that a country should have the sovereign right to its data. The government, in its draft proposal, has proposed that all e-commerce websites and applications available must have a registered business entity in the country. Moreover, the 42-page draft policy, which is open for public comments till the 9th of March, has also put restrictions on cross-border data storage. Mukta Warrior is here with the details. Mukta, take us through the key highlights of the draft policy. It's a 42-page report. Of course, it depends on what the consultations are to assess what the final details would be. But, you know, who does it benefit and who could it be negative for?
Yes, you know, this draft e-commerce policy has wide-ranging points affecting different stakeholders. Now, here's what is in store for the e-commerce players. You know, the government has once again reiterated that FDI will be allowed only in the marketplace model and not in the inventory model. And it will also make it mandatory for all e-commerce platforms available in the country to be registered in India. Now, remember, the government is also pushing for, you know, its cause of data localization, and it proposes to ask these e-commerce companies to take steps to facilitate data storage within India, and will give them a window of about 3 years to comply with these norms. And the government is also sticking to its stance of data sovereignty and how data of Indian users will be used. And, you know, it will completely bar any sharing of data of Indian users which is stored abroad with any third-party entities or, you know, even foreign governments. So, you know, a lot of restrictions, a lot of points for e-commerce marketplaces. Now, for consumers, there is, you know, something good to look forward to, because this policy looks to address the issue of counterfeit products, which has become a big problem for e-commerce. And, you know, this is through ensuring that e-commerce marketplaces list all the important seller details on their platform, and that they also get authorization from the trademark owners for, you know, high-value goods and, you know, cosmetic goods and so on. Now, for small traders in the country, there is some boon, because remember, they were being, you know, drowned out by cheaper Chinese products coming through popular e-commerce apps. But, you know, the gifting policy which these apps would use will be suspended. So that is a boon for, you know, some of the small traders in the country, while there is also promotion for exports by increasing the limit for the courier mode of e-commerce exports. So essentially, you know, the policy largely has been welcomed by the industry. Platforms like Amazon, Flipkart, etc. have said that they're evaluating the policy and will share the feedback. But certain trade associations such as the All India Online Vendors Association and the Confederation of All India Traders say that the policy is still very restricted on FDI and should also encompass the domestic e-commerce players. Now, all these stakeholders can send their feedback on the draft policy till March 9th, and now it remains to be seen what will be incorporated in the final policy.
Okay, fair enough, Mukta. We'll leave it at that. Thanks for joining in with those details. Now, the Parliamentary Standing Committee on Information Technology met today as Twitter's Vice President Colonel Crowell appeared before the panel instead of the company CEO Jack Dorsey. Now, sources say that Anurag Thakur, who is the chairman of the panel, read out a personal letter addressed to him by Jack Dorsey and allowed Colin to appear before the panel. The lawmakers are also believed to have sought some written responses from the company following Crowell's testimony. Remember, the parliamentary panel had disallowed Twitter Executive Director of Policy for South Asia, Mahima Kaul, to dispose before them on the 11th of February after Twitter's testimony. The lawmakers have now summoned Facebook, Instagram and WhatsApp officials on the 6th of March. These hearings come in the backdrop of allegations of political bias on social media platforms by some right-wing activists. Welcome back. Now, tensions in the Kashmir Valley have escalated further with a hearing on the constitutional validity of Article 35A at the Supreme Court likely this week. Meanwhile, it is also being speculated that the centre may scrap the article through an ordinance. Article 35A allows the J&K legislature to define the state's permanent residence. Former J&K Chief Minister Umar Abdullah has warned that if the centre interferes with the section, chaos in Kashmir will be worse than Arunachal Pradesh. His warning clearly comes after the Congress and the CPM vowed to stage protests if Article 35A is diluted in any way.
जनाब, आप जम्मू कश्मीर में 35A के साथ खिलवाड़ करोगे, अरुणाचल से ज्यादा बदतर यहाँ के हालात हो जाएंगे होंगे। और मैं धमकी नहीं दे रहा हूं, एक जिम्मेदार बाशिंदा होने के नाते मेरा फर्ज बनता है दिल्ली को मैं बताऊं, जनाब आपकी सोच सही नहीं है।
Meanwhile, the central government has deployed additional troops in a bid to quell panic and protests in the valley. Mufti Isla joins in now with further details. Mufti, what's the update on the ground right now?
There's a lot of anger, apprehension and anxiety here in the valley over Article 35A. Although this case is not listed for tomorrow as yet and would be known only by the evening, clearly the valley is on edge. We heard leaders from Omar Abdullah to Mahbooba Mufti to Saifuddin Soz, all essentially putting the centre on the notice that if any amendment or tinkering is going to happen on 35A, they will hit the streets. This is the same sentiment which is reflected across the valley, whether these are people associated with trade, travel, tourism or anything related to citizens. Clearly at this juncture I can tell you that it has to do also with the apprehensions that are on the ground, especially after centre rushed some additional 12,000 forces into the valley who have been now deployed across the Kashmir Valley as also in Srinagar, and people are also linking this with the widespread arrests that are taking place. A massive crackdown is in place as we speak. Some 200 people from Jamaat-e-Islami, separatist outfit and former stone pelters and protesters have been arrested. All this is giving vent to the feeling here in the valley that perhaps centre is preparing for something nasty to take place here in the valley. So far, the legal status of Article 35 is that it's going to come up for hearing, and the state leadership is asking the centre that they need to come and respond on this issue so that these fears are allayed. I did speak to the governor administration here, Governor Satyapal Malik, telling us that nothing nasty is going to happen to Article 35A till you have an elected government which is going to take a call on this contentious issue. In Srinagar, this is Mufti Isla.
Okay, Mufti, thanks for joining in with that. Now, news from Arunachal Pradesh then. After 3 days of unrest over the permanent residence certificate issue, State Chief Minister Pema Khandu has assured that the PRC will not be given to the 6 non-tribal communities from outside the state. The Chief Minister has in fact also called for an all-party meet to assess the situation. So far, at least 3 people have been killed and over 35 injured in the protest. However, there was no report of any violence in Arunachal Pradesh today. State's capital, Itanagar, continues to be under curfew.
We were informed that the state government has asked for additional forces, and the state police, they have already maintained and contained the situation under control. The state government has already taken decision to not to agree to the PRC, to the non-tribal people living in Arunachal Pradesh. So things should be normal now.